Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. Before we even start this market call, by the way, June 25th, a Tuesday day. Month is going by, Dan, like what?
Like that.
It really is. I mean, it's remarkable. We just started June, and now, because I remember saying June is busting out all over, and you said, what's that? And then Jacob said, actually, it's not the Music Man, it's whatever. You remember that whole thing?
Yeah.
But kudos to the Florida Panthers, who last night emerged victorious in Game 7 of the Stanley Cup Finals. And as discussed on CNBC's Fast Money set prior to the show yesterday, I turned to Tim Seymour and said, if the Panthers win tonight 1-0 or 2-1, Connor McDavid will be awarded the Conn Smythe Trophy for most valuable player throughout the playoffs. And that actually proved to be correct. One of the few things that I actually have gotten right. So there you go. How are you, Dan?
One of the very few. Come on, Guy. When
it's factually
you're
true.
So fixated on these months, you know what I mean? It brings me to the Simon and Garfunkel tune, "April Come She Will," right? And what does June do? What does June do? Can you come up with that? Come on, really quickly.
I'm not really sure what June does.
June, she'll change her tune. You like that?
By the way, June Cash was married to the great Johnny Cash, as you know, for those playing our home game. That was played by, I believe, Reese Witherspoon.
Yeah, April Come She Will. May she will. He will stay and change her. All right, well, let's get
now.
On.
Amanda, who was on jury duty yesterday, so she did not have to endure our tomfoolery, is here today. So no doubt, rolling her eyes as we speak. So let's get right to it. By the way, we were supposed to have the great Carter Braxton Worth. I teased that yesterday, but Carter is in Portugal, and apparently he had a flight that was delayed or something like that.
How you get there? You fly there.
Portugal.
Yeah, I mean, when you used to vacation back in the day, you would have to book.
We booked passage on the Queen.
Yeah, exactly.
$5 for the first person. Anyway, let's throw the rundown up there because why not? Rotation in and out of Nvidia. It should be out and into Nvidia given the price action today, but I get it. In and out like the burger. Consumer conundrum. That's a bit of a alliteration, as they say. Uber, the sleeping giant. That's not our phraseology. I think that's the words of the Goldman Sachs analyst. And we'll do a little audience Q&A because it went so well yesterday. So why not? And you can ask us, by the way, it doesn't have to be just market stuff. I mean, you got shit on your mind. You might as well throw it our way. Is that correct, Dan?
Fair enough. Yeah. I mean, let's just get open with the people, Guy. Like, let's just let it all out there. Hey, before we get to this in and out the in and out rotation of Nvidia, maybe Jacob could pull up like a 1-week chart, because I think this is kind of interesting to just kind of put the volatility in some context for the Nvidia here, guys. So, the stock gapped up, I want to say, on June 20th, and we'll be able to see that as soon as they bring that up. Okay. And it touched almost $141. And it's been kind of a series of kind of lower highs and lower lows until today. And just, look at how the stock fell off late in the day, closed down 6.5%, and then to kind of gap higher 2% and then keep on going. Thoughts here on just this chart before we get to, the 1-year chart?
Yeah, okay, that's fair. And I think the bounce today, although I said yesterday on Fast Money, I thought the sell-off would continue. I'm not backing away from that. And I'll go back. I think it was June 18th, again, if memory serves, was that sort of reversal day, the same type of day that we saw back in early March. And we pointed it out yesterday. It's not easy to see, obviously, on this chart, but if you were to sort of make a longer-term chart, you'll see exactly what we're talking about. We discussed it yesterday. So we're getting a bounce here today. The positive commentary continues. There are a lot of people in the peanut gallery continue to sort of trip over themselves on sell-offs to try to sort of get, their word in terms of their bullishness around Nvidia. There was somebody on this morning, I think, on Squawk Box. I get it. But I also say this, that pattern that we saw last week is a very powerful one. You saw what happened back in March. It took a lot longer then for the stock to sell off, but it sold off in a pretty meaningful way. I think from peak to trough, Dan, I think was about a 24% move, which is not insignificant. And you're starting to see, again, you saw it yesterday. You saw it a couple trading sessions ago. Obviously, today is a bit of a reprieve, and we'll see how it closes. I mean, if you're looking at the S&P real quick, that's given pretty much the entire day's gains back. Obviously, the Dow's been under pressure most of the day. We continue to talk about the underperformance of the Russell. So there's a lot going on. On a day where the S&P is up 2 handles right now, you'd be like, there's nothing going on. once again, that's incorrect. There's actually a lot going on.
Well, and just to talk about the rotations, right? So yesterday you saw the semis get hit here, and across the board, I don't see that many semis acting particularly well. The SMH is up 1%. And if Nvidia were to reverse for any reason, and you talk about that kind of June 20th day, June 19th was closed, the market, right? And June 18th was that kind of day where, the stock was set up pretty nicely, and then it gapped up on the 20th, and then it reversed. And since then, I mean, at its lows yesterday, Guy, I think it was down 18%. And it kind of brings us back to that point that we were talking about in April, right? Where the S&P sold off 6% from the March highs, and Nvidia at its lows was down 23%. And think about how much higher the stock is now. And so if you're going to have money flows keep going in and out of, let's say, from the semis, then over to the financials and energy and this and that, whatever, you're going to, at sooner or later, and this would be my 2 cents on this, guy, sooner or later, if the Nvidia and a bunch of the other semis start heading lower, the correlations are going to go to one, meaning like all the money that was flowing into these other groups, it's going to come out of it because there's going to be weak hands, especially if the leadership has sustained downside. So what do you think of that? What do you make of that theory?
It makes a lot of sense to me, and just in terms of the math associated with what you said, and just the weighting, which obviously is part of the math equation. It's going to be very hard, I think, for the broader market to sustain itself. I mean, you can rotate all you want into banks and energy, and I'll use this term much to the chagrin, I'm sure, of a lot of people, but those have become a fly in the ass of technology and a little more narrow semiconductors. So they cannot carry the weight, to quote a Beatles song. And I think at a certain point, the broader market starts to come to that realization. We'll see. I mean, we had the conversation yesterday, and we're going to get into a consumer conversation here, but there's obviously weakness on the edges at certain point that all works its way through the system. And whether you want to acknowledge it or not, at some point that makes its way into the semiconductor trade, as somewhat counterintuitive as it might seem, because everybody seems to think it's this new sort of secular bull story that is impervious to any downturns.
Yeah, and this also brings me back to 2020 and 2021 when rates were, at zero for all intents and purposes, and folks were just kind of YOLOing every, sort of tech stock, every consumer-oriented name. And the moment that the Fed signaled that they were going to raise interest rates, all those long duration assets, they started to get killed. And so, let's put up the 10-year Treasury yield. You and I have been quoting the CME Fed Funds Tracker. A lot of folks think that there's a potential for, a rate cut, coming in July. You and I don't think that's happening. We don't think it's going to happen in September. Maybe you get 25 bips in November, but all the Fed speak, for the most part, just speaks to higher for longer. And my question to you, Guy, is that we're stuck here at this kind of 4.25 level in the 10-year, and it seems like something's got to give. Is there a piece of economic data that you want to focus on or anything like that over the next coming weeks? We know that the first week of July, it's a holiday shortened week. I think they have jobs, right? Isn't that the Friday, despite the fact that
yeah, you haven't. I think the big numbers.
I'll check.
Look right now, Friday. There's an inflation number, which obviously I think is.
It's this Friday, but I mean,
a lot of people are focused
Friday.
on. I mean, the jobs. Look, again, I'll say this because we tease consumer again, but whether the administration or the talking heads or anybody wants to acknowledge it, I mean, there is damage being done under the surface in the job market. I mean, the headline numbers are what they are, but when you sort of dig a little bit deeper, you see that the strength that it appears to be is not really there. It's to a certain extent a little bit of smoke and mirrors. And I do think, and I've thought this for a while, that the unemployment rate was going to start to move in a pretty meaningful way higher. And quite frankly, if you look at these consumer names, which we will look at, they're telling, I think, the real story in terms of yields. And another Fed speaker, as you said, needs steady policy rate for some time to beat inflation. I agree with that. Pull up a TLT chart. Today, you have a bit of a reversal today in the TLT. If you look, it traded, I think, all the way up to 94.40 or so, maybe 94.37. It's reversed. Again, it's not a huge move. I'm not pretending it's a huge move, but you got to watch these things. So we'll see. We'll see what the bond market is trying to figure out. I mean, it's struggling here without question to figure out: is it a slower growth story, which means rates go lower? Or is it a supply demand story, which means rates go higher?
So next Friday, so this would be July 5th. The stock market is closed on July 4th. It's a half day on July 3rd. And it's interesting that this jobs number comes out that Friday morning, which is going to be a very low like a low vol day. All right, hold on. low
Yes.
participation day, right? So, there's things that could happen on that Friday afternoon that would be really interesting. So one thing I want to mention, you just talked about the unemployment rate. The survey says 4% last quarter, or last month it was 4%. This is one thing that's really interesting. So change in non-farm payrolls was 272. So remember, it was a bit hotter, right, in May. And then the change in private payrolls, 229. This was back in May. Look at what the expectations are for non-farm: 185,000 and 165,000 for May. So for private. So when you think about that, okay, guys, like, there's a really good chance that the numbers that come in are hotter than what the survey suggests. If you're just thinking about what the average has been over the course of this year, right? And what we just printed last month, as long as there's not like any big revisions lower. So my point is like, if you get non-farm, okay, up above 200,000, maybe 220 or something like that, and privates up near 200 or something like that, that's going to be a very hot number.
And I don't know how the market will react to that. I mean, theoretically, yields should go higher. The market shouldn't like it because the market has liked bad news as good news. But then you throw in the fact that the revisions that you invariably see each month with this, what it's come down to is this. The market is, there'll be people in both camps. They've dug themselves in. It's sort of World War I trench warfare. Nobody's coming out of their foxhole. Everybody's going to lob their missiles, over at one another. No ground has really been gained one way or the other. And, people just want to look at the numbers. They want to look at them. That sort of reinforces their belief system. So, I think I got a decent handle on what's going on, I think, but I'm not suggesting, I have a complete handle or I'm an economist in any way. I do think there's deterioration under the surface. If there were not, you wouldn't see some of the commentary again out of some of these retailers, and you wouldn't see the stocks act in kind to the downside from some of these retailers. And I think that's sort of the first salvo in terms of a weakening U.S. consumer.
All right, so this is an interesting one. That's a pretty decent segue here. Here's a stock guy. I'm going to tell you this. I have never heard of in my life. I've been in the business since 1997. Okay. I've never heard of this company. It's called Pool Corp. Okay. They distribute swimming pools. Okay. And it was at one point down 10% on the day. And it's interesting that I just said 1997. This company went public through Robinson Humphrey on October 12th, 1995. And then they did a secondary that was at 10.5 bucks. They did a secondary at $18 in December of 1997. The stock is trading 314 today. It was down 10%. So they're talking down. They guided down for the balance of the year. And, one of the reasons I even caught this is like, I was looking at Home Depot. I was looking at some of the home builders. They're absolutely getting throttled today. So how is it that a company that you and I, and I'm going to speak for you, have never heard of, right, that distribute like swimming pools, is taking down the home builders and some of these related retail stocks?
It's interesting. The only reason I've heard of it is because Doug Cass has mentioned it in months past, and this is one of the larger short positions that he has had on. And I know he wrote about that yesterday. So again, kudos to Doug. But but for Doug, I would not have heard of it. So you're correct. And if you do a longer term chart, you'll see. And how is it? I mean, Doug can wax poetic here, but that might be sort of, again, another warning sign, another salvo as to the state of the consumer and the saturation potentially, and the lack of appetite for some of these discretionary items. Obviously, pools being probably at the top of that list. I mean, boats are probably a close second, and we had that conversation on Fast Money last night. So yeah, I mean, I think this is all part of that sort of mosaic that we've been talking about for a while. Now, the problem it falls on deaf ears is because at 54, the S&P 500 is within 50 handles or so of an all-time high. So I understand people's want not to listen or hear that, but it doesn't mean it's not happening.
Yeah, it's interesting when you look at a company like this and we talk about the consumer behavior, right? And from goods to services, back to goods, this is a company that, you know, it's goods and it's also services. Like, think about what people need to do. I was talking to AD, that would be Amanda, earlier today, and, you know, she's pricing out a pool, you know, and I said, well, it's probably not a bad time to do it. But it's not just like, you know, buying the pool, it's putting the pool in the ground and digging the ground out, and then, you know, landscaping it and putting a deck around it and all that sort of stuff. So, and I think this 5-year chart is really interesting because the stock has basically been cut in half from late 2021. And that's a great, I think, example of some of the behavior that we're seeing in the stock market, because we're seeing certain consumer behavior with everyone stuck at home and all that sort of stuff. And they're like, hey, let's put a pool in, you know.
That's right.
So again, I think it's pretty interesting. $300 important. Let's pull up Home Depot and Lowe's though, because, you know, like Home Depot, when I looked, it was down like 4% or so. I mean, that's a really big move, guys. Home Depot.
It's a really big move. It obviously brings us right to that 200-day moving average, which I think is pretty important. I mean, again, this is not Home Depot specific, by the way. I mean, this is across a swath. If you pull up a Masco chart and some of these other names, they're going to look eerily similar. And it speaks to, again, some of the things we talked about at the top of the show. The consumer is without question slowing down. And, you know, people ran to Home Depot. If you go back a longer term chart in Home Depot, you'll see it's not coincidence to see the strength of Home Depot and sort of when it reached its zenith. I mean, probably the same time that Pool Corp did, quite frankly, as people flocked there to do and buy things for their home because they were stuck there. And if you go back and look, the all-time high was probably made, I don't know, late summer, early fall of 2021. And quite frankly, we've never gotten back there since. And we've been trading sideways on what's been a very good tape. So again, it speaks to saturation. I think to a certain extent, it might speak to valuation, although not as much, but this is concerning to me. I mean, it's just, again, it's anecdotal to a point, but it's a part of a bigger picture, Dan.
Yeah. You know, what's interesting, you know, Guy, I looked at my screens, you know, my FactSet screen. I use it as kind of a heat map. I probably have 300 tickers there organized by sector and subsector and the like. And I looked at a bunch of these home builders. I looked at the retailer names that are associated with it. And then I looked at yields, which was kind of the obvious thing, right? I was like, well, are yields higher? You know, I already knew that yields weren't higher. I just wanted to see if they had kind of spiked or anything like that, and took these names down. And that's how I found Pool Corp, again, which I'd never heard of, and Doug's been writing about it. I just kind of missed that note yesterday. When you look at, let's look at the XHB, okay, and let's look at the ITB, two very different, you know, ETFs. One is just pure home builders, and the other has a lot of this retail stuff in it. And I look at these. Let's put a 1-year chart. Well, look, that's interesting. That flag that's being made.
That's exactly what it is.
Yeah. So talk to me a little bit about like what you're seeing in the space, because I feel like if rates were to go back higher, right, that this space is going to get nailed right then.
Yeah, agree. And if that's, so that's a little longer term chart. I think if you do a shorter term, you'll see exactly. So what you'll see since March is a series of lower highs. We have not made lower lows. We've basically made the same low right around 100-ish, but we have made lower highs. So you see that first high, obviously the second high in May, and then you see where we just traded up to a week and a half or 2 weeks ago. So that's a formation you have to keep in, you obviously have to be aware of. I think it's a pretty poorly constructed ETF, but that's neither here nor there. That's not the point. This is something that people watch. And again, through 100, I think it starts to get a little bit dicey here. And it feels as though, to me, that's exactly what we're setting up for. And I do believe, again, my opinion, this is another warning sign in terms of what's really going on under the surface, not only with the broader economy, but more specifically with the consumer. So I think I think if you're long this, you have to be somewhat concerned. But if you're just looking at this for guidance, you have to glean something from it.
Yeah, it's funny. I was looking at the XHB and I was like, that $100 level is a big level. And look at that 200-day moving average down there. It's just I don't know, about $10 lower or so. Does that look right? I think
it probably comes in around 94.90 if I had to guess. Okay. But
so I'm looking at like the 100 puts in July. And so one of the things I was thinking about is like, okay, let's say you have a hotter than expected jobs report that comes out July 5th, right? And then we have CPI the next week. Let's say that kind of, stays pat or kind of goes up a little bit. This space is going to get nailed again, like we just said, if you do see, if you do see yields go higher. Let's say we're at 4.5% by mid-July or something after the CPI. The 100 puts are offered at about 235. The 90 puts are about 35 cents. So you could put on the 190 put spread for $2, guys. So that would break even down at $98, right? And you have up to $8 of gains between 98 and 90 with a max gain at 90. I mean, I think that sets up as a pretty decent, risk reward there. Thoughts on pressing it here, or would you want to wait for a little bit of a bounce?
No, I think you're right to look. Well, I think you're right to press, because typically when you test something a number of times, especially given the fact that we've made these series of lower highs, and that's really what's, to me, that's what's dominating. I think it's set up to break, and I understand why you'd want to sort of offset some of the costs by, selling the 90 put for 35 cents. I totally get it, and that's a style thing. The other side of that equation is, if you're right, which I think you're going to be, I mean, all of a sudden 90 might actually come into play, quite frankly. So, you want to offset cost. I get it. But, this is one, and we talk about this all the time, and I'm not suggesting people do this because it doesn't necessarily always work. But this is one where you say to yourself, okay, I understand what Guy is saying in terms of those series of lower highs. I see what Dan is looking at in terms of the options. Maybe I'll buy that first strike put.
Yeah.
And then I'll wait to sell the 90 put. I'll sort of leg into it, because if it starts to work in my favor, which I think it will, the 90 put, which I just sold for 35 cents as part of a strategy, I can leg into and maybe sell it for double that a week or so from now. So, again, that's just a style thing.
Yeah, listen, and the probability of it getting to 90 in the next month or so is not particularly great, but the idea of selling a 35-cent put on $100 stock is also not great. It's not great practice in general. And so sometimes I just look for things to be kind of symmetrical, if you will. All right, Guy, I want to go to something. So last night on the desk on Fast Money, we had Savita Subramanian, who I think you and I both think is a total rock star. She's the head equity strategist and derivative strategist of B of A. I've known her for a very long time. We're trying to have this conversation about the consumer. She thinks the consumer is in really good shape. And she said that on many occasions. I thought she sounded a lot like Brian Moynihan, the CEO of her bank. And we've been noting for like 2 years that Jamie Dimon, the CEO of JP Morgan, has routinely been very cautious on a whole host of things, but also on the consumer. And so I find this tweet from Liz Ann Saunders this morning pretty interesting to me. Survey from TransUnion shows that across all generations, a good chunk of respondents have cut back on discretionary spending. Okay, so that makes sense for what we just heard from Pool Corp. But then this was a response from Global Markets Investor. Credit card serious delinquencies of 90 plus days reached 7%, the highest level since 2011. The credit card debt is at 1.1 trillion. You've mentioned all of this on many occasions. Thus, 78 billion of credit card debt is near a default. Consumer has been in the worst shape since the great financial crisis. Now, that maybe it's hyperbolic. I don't know. I remember the movie The Big Short that our good friend Danny Moses was featured in. I remember that whole bit. It was really great with Gosling. Remember he's pitching him the trade about CDOs and everything like that. Dog shit, dog shit, dog shit. You remember that? He's throwing the Jenga pieces in the thing. And he's talking about, you and I who are equity monkeys, you know what I mean? Like that sort of thing. But he was talking about default rates going from like 2% to 5%. And then the whole thing comes crumbling down. Right. So it was kind of an interesting analog, maybe not that helpful here, but I think this conversation is interesting. And, Savita really was not having any of it. And you and I were trying to kind of get in there a little bit on the consumer, but is this alarming to you?
Yeah, it's been alarming. Thank you for bringing that up. I mean, we've talked about this for a while, and, I'm not Jamie Dimon. He speaks about things like this many times over the last year and a half or so. I mean, Brian Moynihan's in a different position. Maybe he has a different vantage point. But I will tell you flat out, when a number of things, when you talk about 1 in 5 people consider themselves food insecure, 1 in 4, 1 in 5 people in the United States, if a $400 emergency expense came up, wouldn't be able to handle it. People living paycheck to all those things are factually true. Then you layer on top of that credit card debt, and people will say, well, the population has grown. It's not a big deal. All right. I'll say this. What is going on here is people are combating inflation with credit. I mean, that's exactly what's happening. And then when you see delinquency rates where they are, obviously you start to say, wait a second, this isn't working out that well. So you can say what you want, and I don't think it's hyperbole. I think the numbers are the numbers. I mean, I don't think the consumer's in great shape at all. Now, understand the condition of the consumer has nothing to do with his or her want to spend. I've made that distinction 100 times. They will spend in just about any set of circumstances, especially when they're forced to spend more because things cost more. And if you think about this, if the economy was so great and if the consumer was in such in great shape as a lot of people claim them to be, and again, politics, I'm not interested. This is not a political comment, but the approval rating for this administration when it came to the economy would not be in the low 30 percentile, would be north of 65 or 70. So something's amiss here. And I think speaks to the real state of the U.S. consumer.
Yeah, and so there's some examples in the stock market that kind of demonstrate that there's two economies right now, right? There's two different sort of consumers, and this was kind of my pushback to Savita. You've mentioned these dollar stores on many occasions. We talked about Walmart and the trade down that you've seen to names like that. Let's just pull up Dollar Tree and Dollar Gen really quickly just to show that they have not been participating at all, and then there's another example. Look at that thing. It's looks like it's going to fall off the page here, right? A little bit. And then the Dollar Gen really quickly. So, just kind of stuck in the mud. But Amanda put together this graphic, which I thought was really interesting, Guy. And this speaks to the two different sort of economies, the two different consumers. Like Kava's up 125%. Those are people buying I don't know what they call them, salad bowls with
Mediterranean.
Yeah, but for $15. Chipotle, you get a burrito bowl for $15. The Domino's, you buy a $15 pizza. McDonald's on the flip side and Starbucks, they're racing to the bottom. They're trying to, lower the cost of all their meals and do these value meals, So I just think this was kind of interesting. And those stocks, McDonald's and Starbucks can't get out of their own way. And these other ones look like Nvidia. The Kava chart looks like Nvidia.
First three, again, are very individual, stock-specific, company-specific stories, and they're all working. I mean, Chipotle, we've talked about forever in terms of their ability. I mean, it's basically become a margin story and, a performance story if you think about what they've been able to do. And I mentioned it last night on Fast Money. You talk about one of the great success stories in coming back from almost extinction. I mean, and I'm not saying that hyperbolically. I mean, it was true. They were in a lot of trouble a few years ago when that whole what was it, E. coli thing came across their bow, and they handled it very poorly. Since then, they've done everything exactly right. Kava, I think, is its own story. That's a bit of a growth story right now, by the way, that will run into a valuation problem at some point. But right now, nobody cares. And Domino's has been sort of this transition to a technology story. A lot of people think DPZ is exactly that. It's become a technology company. On the flip side, more mature companies like McDonald's, what are they running into? Well, they're running into the fact that their consumer is strapped. And they said it 2 quarters ago. Their CFO, I think, made comments that, their customer was feeling the pinch of prices, which I had never heard before from McDonald's. And then Starbucks, last but not least, I mean, they have a couple different problems. I think they have a China problem. They have a saturation problem. And I think they probably have a margin problem as well. And that's manifesting it into the stock too, which people are looking at and saying, you know what, it does not deserve it of that premium valuation that it enjoyed for so long. Yeah. So it all sort of does make sense.
Yeah. The last point I'll just make about McDonald's and Starbucks is that, you talk about these value offerings that they're doing, and we know that their cost of labor has gone up and some of these other costs have gone up, and their ability to pass through those increases is gone, right? So especially that's evident by the fact that you are, doing these value meals, even if they're for short periods of time. Guy, I wanted to hit this one. I thought it was interesting. I feel like Goldman, as long as I've been in the business, has always been a bull on Disney, but they initiated the stock with a buy. Stock was up a little bit earlier in the session, and I think it's unchanged or down now. Mm-hmm. Thoughts on that? I mean, this one is kind of hanging in there above its 200-day. It's still got that valuation issue. It's still got the issue as it relates to, their kind of networks business and the like here. Like that
Well,
little
you don't have Nelson Peltz basically kicking the tires, and I think showing people what let's put it this way: when you heard that he exited his position, and if you think about it, he probably did it within a whisper of that recent high. I mean, first of all, good for him, but my sense is if you really want to read the tea leaves, he probably said to himself, it's like that Gordon Gekko thing. He realized that it's not going to work out. I'll take my profit while I can, and I'll live to fight another day. I mean, and I think that's exactly what Nelson Peltz came to, that realization that this was not a battle that he was going to win anytime soon. And quite frankly, he probably, and I'm saying this respectfully, he doesn't really have the time to wait around for Disney to get their act together. The problems at Disney have not gone away at all. I mean, I think they were sort of put on the shelf for a little while, but there's still total headwinds in terms of the stuff that they face that they need to figure out. And people have talked about, a 3 or 4 year problem for them to sort of unravel from, that they're probably midway through year one. So when you don't see a stock act in kind, and I think they initiated with a $125 price target, I think that's problematic. Obviously, there's still some day left, but it's like the Uber. We're going to talk about that in a second, I think. I mean, it's like that upgrade. When stocks don't react the way they should, that's a bit of a tell.
Yeah, really quickly, Guy, let's hit FedEx and UPS. FedEx reports after the close tonight, 7% implied move in either direction. Just look at this chart. There's been two huge gaps, one lower 2 quarters ago, one higher last quarter. Interesting. We talked about this yesterday, filled in the gap, trading right around that 200-day moving average. I just want to pull up UPS for a second here. And again, I think you're going to say that FedEx has some of their own problems. UPS are a bit different. Look at that thing. It trades like unholy death here. So back to the FedEx, thoughts into the print. I mean, I just, I get it. You see these big gaps from a trader perspective. Maybe it's something you kind of, if you have conviction on one way or the other on the FedEx, let's pull that one back up.
I don't, but if you look at the last quarter, I think they reported on March 21st or something. The market really enjoyed the fact that, first of all, FedEx, say what you want. I mean, it basically comes down to FedEx Express. I mean, they do $20 billion or so of revenue a quarter-ish. Half of that is from Express. So the other 8.5 is ground, and the balance of like $2 billion is freight, just so we know what we're looking at. But the market really enjoyed the fact that the operating margins for Express were 2.5%. And the street was at 1.1%. That suggested to people that, oh my God, they figured this shit out. And if you look at the stock, I mean, that's why it gapped the way that it did. It's given the entire thing back. I don't know what to make of that. I really don't. I mean, because if they pull another rabbit out of their hat, you're going to see the same type of move back to, I think it got up to 290 or so. So I don't want to pretend that I know, but I'll tell you, if you go back historically, it's sort of one good, one bad. And that suggests that this might be the one bad.
Yeah, except one point, and you brought this up a couple times over the last couple of weeks. Look at the transports. Look at the IYT.
Not trading well.
Not trading well, down about 10% from those highs from, kind of late March, early April or so. And I just think that there's a potential, like all that slowdown that you're talking about, if you're seeing the consumer start to slow down, you're seeing discretionary spending start to slow down, it's going to manifest itself, you know what I mean, in, the truckers and the shippers and, all that sort of stuff. And which brings us to the Uber, which is one of the largest.
Oh, it was Piper. I thought it was Goldman, but I'm sorry.
Yeah, no. And so let's look at this one. I mean, the stock has been coming in. There was a gap lower after, I think it's last earnings or so. Lyft has been going in a different way, sort of. You and I, we don't trade upgrades. You know what I mean? Sometimes it's kind of interesting to see sentiment shifts. You know what I mean? Like as they relate to a specific analyst. Maybe they've been right. Maybe they take a victory lap, that sort of thing. I don't think that's the case here, but thoughts on this Uber upgrade? Is this a name that you find particularly interesting?
You've probably forgotten more about Uber, and you do obviously OK Computer with Deirdre Bosa, and I'm sure Uber comes up from time to time. I mean, I'll say this, I think if you go back a longer term chart, when Uber was in all the different businesses, people would say that Lyft was more of a pure play. And then I think Uber started to get reap the rewards of their hard work when they started to figure it out back in, a couple summers ago. So the story makes sense. It's a story of, we're going to really grind for a while. We're going to take our lumps until things, we start to get transformational and we start to see the network effect of what they've built. That's what we've seen. I think valuation has to be a little bit of a concern here. However, you read the Piper note and they say, this is completely mispriced. So I don't know what to tell you. I will say on the good news is every time we've traded down to the 200-day moving average, we've bounced, most recently with that last leg lower that you just mentioned. So we'll see. Oddly enough, I do think Uber is the number one holding in the IYT. If it's not one, it's two. So it's obviously a pretty important stock right here.
Yeah, and one thing I'll just say about the valuation is like on a GAAP EPS, basis, the stock this year, 2024, the company is expected to see only 7% earnings growth, but going up to 130% next year, guys. So that multiple goes from 76 times this year, that's on a GAAP basis, to 33 times next, which is still expensive when you consider that revenue growth is expected to be 16% over the next 3 years or so. But this is also a company that doesn't have the sort of gross margin that you might really enjoy in a software services name, with 70-80% or something like that. They're about 40% or so. So this one, let's see what they have to say on guidance. I'm hard pressed to think if there's a consumer pullback right now in discretionary. Maybe for some people, taking an Uber is a necessity where you don't have public transportation. But I think for a lot of people, it's probably a discretionary sort of situation. I could be wrong on that, guy, but who knows? All right. I got
some questions.
Yeah, let's do that.
So Gary Webb, and I'm reading, I apologize. Guys, what do you believe the implications to our markets would be if the dollar yen eclipsed 160? Eclipse is a great name for large people that, they're so big they eclipse the sun.
It's also a great song by Pink Floyd, which you probably have on your 179 Spotify playlist.
Yeah, I am not I'm not a fan, as you know. Let me say this about dollar yen. I think it's, as we're sitting here, it's 159.70 or thereabouts. We briefly breached 160 yesterday. We obviously did it back in April. Bank of Japan intervened. They got it down to 152. And then we spent the rest of the last month and a half, 2 months, basically going right back. I mean, they are basically, Bank of Japan is spinning their wheels. They're screwed, whether they realize it or not. They are. I think they probably do. They're going to try to raise rates. They're going to do what they can to defend their currency. But, if we get, and I asked last night on Fast Money, where are you going to start to hear people, what level is when you start to hear the term currency crisis? And the guest we had on last night suggested it was about 165. I mean, okay, I'll buy that. But I don't think enough people are focused on what a breakdown in the yen subsequent with rates going higher in Japan, the fourth largest economy in the world, what it potentially could mean to, I think, global markets and maybe specifically our bond market. And that's something that I've been trying to point out correctly at times, incorrectly at times, vis-a-vis the price action. But I'm going to stay on that hill because I think it's really important.
All right, Guy, you're on a bit of a roll here. So
not really.
We're gonna stick with a question I think works well for you. This is from Buseal 08. Okay, looking to add more to the mainstream or midstream space with all the potential AI power demand. Thoughts? I thought that's interesting.
Look at VSTR. I believe the symbol is VSTR. That's Vistra, which is, we probably don't talk well. I mean, let's put it this way. It's VST, excuse me. So this is a stock that nobody ever heard of, and was basically minding its own business for 5 years, trading around $25 to $30. And now look at what it's done over the last specifically 6 months. I mean, that is not, by the way, that's not a technology stock. That's not a biotech stock with a phase 3 approval. That is basically a utility type company. And look at this type of move. So what you are seeing, these AI adjacent companies and in the form of utilities, those are the places to be. And that's just real what's going on. And you layer on top of that, obviously, what's going on around the country in terms of, these heat domes and stuff. And that paints a pretty healthy picture. The good news here is the stock is actually pulled back for you. And this is a name that I would absolutely look at. I hope that answers your question. I think it does.
Yeah, no, it does. Let's hit one, Guy. This might be more for me, which I'd be interested also. This is from Chris E. Are Are you guys watching Wall Street darling Snowflake been buying slowly? So this is an interesting one. Okay. So this is a company that it went public in late 2020, guy. You remember, and it just shot
Yeah.
up. I think it had over $100 billion market cap at some point. You can see from there you go. It's down 70% from those levels. It's really nearing its all-time lows. Okay. It's down 50% just in the last few months alone. They had a disappointing report. Their CEO left earlier this year that people were people were really excited about here. What's interesting is that this company is basically growing revenues, I think 24-25% or so. Okay, so what they do is they structure unstructured data, which is a really important part of generative AI, right? If it's these generative AI large language models are being, trained on data, and then when you think about in the enterprise, right, you need to kind of get that data in a certain spot so it can be used properly, right? But if you look at this, for whatever reason, this company is not executing particularly well, despite the revenue growth. They're going to do $3.5 billion, like I just said, in revenues this year. On a GAAP basis, on net income, they're expected to lose $1.2 billion this year, $1.2 billion next year. And I just said they're growing sales north of 20%. So there seems to be a lack of discipline at some point, right? That's just causing them to have these GAAP losses. What do you make of this, guy? Because again, this is a tough one. They have this company, this competitor in the private markets called Databricks. They just made a couple acquisitions that a lot of folks are pretty geeked up about. They're growing sales similarly, but again, it's in the private markets. Their last valuation was $43 billion in the private markets, and they have probably a third of the revenues of Snowflake.
At Investor Day, they being Snowflake on June 6th, Wedbush came out, remained $210 price target. Goldman Sachs remained, $220 price tag, all basically on discounted cash flow stuff. I think Piper, $240 price tag, all for basically the same reasons. Okay, that's fine. I get it. Stock is not traded particularly well. To your point, I think 119 or so was that prior low a few years ago. At 10 times revenue, which I think it's trading at right now, it's probably still a couple turns too expensive. And, let's look at it on price to earnings. I mean, it's very hard to make a rational, compelling argument on a valuation metric, using PEs. So I don't know what to tell you. I'll say this. It trades like shit. I mean, that's pretty clear. I mean, you go back and look. I mean, I think this is the last level we saw in basically this time of year in 2022. So you better hope it holds basically 119, 120. I'm not convinced that it will. That's just, my 2 cents.
Yeah. And, it's funny. And I mentioned Databricks, which is, again, this is a massive, private company. If you're looking at Snowflake and the way, public investors are looking at, like this growth and the losses and, on a GAAP basis, like, why would you want to go public? Now, at some point, and Deirdre and I just had this conversation on OK Computer, so check it out. It's going to drop tomorrow morning. Why would you want to go public if you're going to have greater scrutiny, right, on those losses, and there's going to be a comp now that trades, like, as you just said, a technical term, trades like shit, right?
Yeah,
so to me, that's it's just kind of an interesting setup. And again, if things do slow down, if the air comes out of this Gen AI trade, all these adjacent names are going to get hit too. I'd probably rather be in the private markets for now, guy.
All right, let's take a look at, because I got a, as they say, Audi 5000. Let's take a look at Brunson Burner, because I think, is this week 6 now?
No, it's week 4. So we launched
No.
Really?
Ask Amanda. Amanda, can you get on this thing? And I'm pretty sure I'm right.
I thought
it's
we
not
launched
4. It might not be 6, but it's somewhere between 4 and 6. Anyway, please.
You know what that would be then? 5. Yeah, look at us. I mean, like, no one said there was going to be any math, but we just did some hardcore math. Okay, so this is what we're doing right here. Every day we have a group chat. Guy, myself, our whole team, we're putting in what we think are interesting stories that we're doing on the tape, on Market Call, but we're trying to differentiate it here a little bit. We're putting in 10 of the most important stories that we see each day about the economy, about the markets, that sort of thing. We actually have it synthesized. So this is a generated AI. Okay, we're using these AI models to kind of synthesize these stories. We put it into a voice bot. That's Brunson. Under 10 minutes, you get what we think are the most important, impactful stories of the day, markets, economy. Go subscribe in your favorite podcast store, rate it, review it, share it. That's how people listen. Every day, we probably, 10, 15,000 people are tuning in to Market Call. You want to help us? Go to the podcast store and subscribe. There you go, Guy.
By the way, once again, G
PCW.
Swizzle is correct. Week 6 started
Really?
this week.
Once
May
again,
20th
correct.
was the first day. That was a Monday.
Okay.
And I went back and did a little calculus, and there
All
you
right.
go.
6 weeks. Okay, we've been doing it. There you go, Guy. I mean, you know, when
Listen,
you're right.
Yankees, Mets tonight, Subway Series. Not at all excited. It does nothing for me. I don't think there should be interleague play. That's just me. I think it's all bullshit. But listen, that's why I'm not commissioner of the Major League Baseball, Dan. You know what I'm saying? By the way, hockey draft comes up very quickly. We should be glued for that without question. And before you know it, it's going to be preseason. I mean, it all happens very fast, Dan Nathan.
Preseason football. Yeah. I mean, this is not, if you want to just kind of take another step back, this is a really bad period, I have to think, for DraftKings and the Flutter, which is the FanDuel, because, you just lost the NBA a week ago. You just lost the NHL last night. You have baseball. We get into kind of Wimbledon, and then you got the US Open and the like. There's probably still a little golf, but I think golf takes a breather in the next couple of weeks or so.
Hold on. I got to take this call. So you take us out.
All right. Listen, thanks for being here. Thanks to our sponsor, FactSet. Thanks to Guy Adami. Thanks to our team. Thanks to the viewer for being with us. Go check out Market Matrix. We got to get out of here. Thanks. Bye.